Hi, and welcome to FinSight's Wealth Your Way, where we make finances simple to help you build wealth smarter. I am your host, Naren. Today, we are talking about something truly exciting that's about to change India's investment world. What if I told you there is a new investment option that combines the best parts of mutual fund and portfolio management services? Something that gives smart investors more flexibility while still keeping SEBI's safety rules. SEBI has just started reviewing applications for specialized investment funds or called SIFs, and they could be a game changer for many of you listening. Whether you are an experienced investor looking for new opportunities or just curious about what's new in India's financial world, today's episode will give you all the information you need. So grab your coffee, get comfortable, and let's break down SEBI's newest financial product, specialized investment funds. So, what exactly are these specialized investment funds or SIFs? Think of them as SEBI's newest creation, designed to fill an important gap in our investment ecosystem. In simple terms, SIFs are investment products that sit between regular mutual funds and portfolio management services, or PMS. They have the safety rules of mutual funds but can use more advanced investment strategies like hedge funds do. The exciting news is that SEBI has already received first two applications for SIFs and is expected to approve them within just few days. This means we will soon see these new investment options in the market. Now, let's talk about what makes SIFs special. Regular mutual funds mostly buy stocks hoping their prices will go up, and what we call long only strategies. But SIFs can also bet on prices falling or staying stable. In simple words, fund managers can make money whether the market goes up or down. That's a big change in India's investment landscape. Another key difference is where they can invest money. Traditional mutual funds mostly stick to listed stocks and bonds. SIFs, however, can invest in many more things, including private equity companies, real estate, and derivatives. Derivatives are financial contracts whose value comes from underlying assets. This gives investors more options to spread their money across different types of asset classes. Let me give you a simple comparison. Mutual funds need very little money to start, sometimes just 500 rupees, and mostly buy stocks hoping prices rise. Portfolio management services or PMSs needs at least 50 lakhs minimum investment and offer personalized investment strategies. And alternative investment funds category needs at least 1 crore and focus on complex investment types. And now coming to SIFs need 10 lakhs minimum investment and allow for various advanced strategies including borrowing money to invest, that is leveraging, and using derivatives. What's really interesting is that despite their advanced nature, SIFs will be taxed like mutual fund. This could save investors a lot of money compared to other similar investment options. Let's talk about who can launch these SIFs. Only asset management companies that already manage mutual funds can create SIFs. These AMCs must have been in the mutual fund business for at least 3 years and have a good track record with no major regulatory issues. Also, they need to have at least 50 crores of their own money to be eligible to launch SIFs. Now that we understand what SIFs are, let's look at their advanced features and what they mean for you as an investor. One of the most exciting aspects of SIFs is their ability to use advanced investment strategies. Let me explain these in simple terms. Long short equity. Fund managers can make money both from stocks they expect to rise, that is going long, and from stocks they expect to fall, going short. Regular mutual funds can only profit when stocks go up. Leverage. This means borrowing money to make bigger investments. While this can multiply your gains, it can also multiply your losses. So it's a bit riskier. Hedging. These are protective strategies that work like insurance against market drops, helping to protect your money during bad markets. Sector rotation. This means actively moving investments between different sectors, like moving money from technology to healthcare or capital goods to consumption, based on which part of the economy expected to do well. Because sector rotation is important when cyclical businesses are moving faster than the non cyclical movements. These strategies give fund managers more tools to make money in different market conditions, not just when the overall market is going up. But SEBI is not giving these funds complete freedom. They have strict rules in place. SIFs must publish what's called an Investment Strategy Information Document or ISID that clearly explains their strategy, risk limits, and how concentrated their investments can be. This protects investors by making everything transparent. Let's talk about regulations in more detail. SEBI has set up specific rules for AMCs wanting to launch SIFs. Each SIF strategy must have a separate scheme with its own ISID document explaining the strategy. AMCs must create a special committee of at least 3 members to oversee the SIF operation. At least one member must be independent and have expertise in derivatives or alternative investments. There must be dedicated fund manager for SIF who have at least 5 years of experience in similar investment strategies. AMCs must have proper risk management systems in place specifically designed for the complex strategies used by SIFs. The AMC must submit quarterly reports to SEBI about each SIF's performance and risk. Now, about the cost, SIFs will generally charge more than regular mutual funds. Investors can expect a 1 to 2% annual management fee plus a 10 to 12% performance fee, a share of the profits they generate. This is higher than most mutual funds, but similar to what PMS and AF charge. Think of it as paying for specialized expertise. SEBI also requires the asset management companies offering SIFs must have separate branding. This means different names, logos, were on websites to clearly distinguish them from regular mutual funds. This helps investors understand they are investing in something different. So, who should consider SIFs? They are mainly designed for experienced investors with more money, including wealthy individuals, professional investors, institutions, and family offices looking for customized investment approaches. But what if you are interested but don't have 10 lakhs to invest? There is some good news. In the future, you might be able to invest indirectly through something called feeder funds or fund of funds that pool money from many smaller investors. Keep watching for these opportunities in the coming months. What will be the market impact and future outlook? The introduction of SIFs is not just another product launch. It's a big change for India's mutual fund industry. Let's explore what this means for investors like you. First, SIFs show that SEBI is becoming more open to financial innovation. By creating rules for these advanced strategies, SEBI is recognizing that Indian investors have become more sophisticated and need more advanced investment options. This move also helps India's markets compete better globally. Many developed countries already have similar investment products, and SIFs help close that gap. This could attract more international money into our markets. For fund managers, SIFs give them a chance to show their skills beyond just buying and holding stocks. They can now use different strategies to manage risk better and adapt to changing market conditions. This could lead to investment portfolios that can weather market storms better. Let me explain some more regulatory details that are important for investors to understand. SIFs will need to follow strict disclosure rules. They must clearly explain their strategy, risks, and fees in simple language that investors can understand. SEBI has limited how much a single SIF can invest in one company or sector to prevent too much concentration risk, putting too many eggs in one basket. Each SIF must provide regular performance reports to investors at least once every month. SIFs must undergo regular risk assessment and stress test. analysis of how they might perform in extreme market conditions to ensure they are not taking excessive risks. AMCs managing SIFs need to have a minimum 50 crore of their own capital, that is net worth, and must have been running mutual funds successfully for at least 3 years. I believe we will see lots of innovation once the first new SIFs are launched. Fund houses will likely compete to offer unique strategies that weren't available before to Indian investors. However, it's important to remember that while SIFs offer more possibilities, they aren't right for everyone. The 10 lakh minimum investment requirement means they are designed for investors who already have some experience and capital. If you are thinking about investing in SIFs when they become available, here are simple tips. First, understand the strategy. Read the ISID document carefully and make sure you understand how the fund plans to make money. Second, think about how an SIF fits with your in other investments. These should usually be added to, not replace your core investments. Third, look at the fund manager's experience with similar strategies. Their past performance can give you a valuable insight. And finally, be prepared for performance patterns that might be different from regular mutual funds. SIFs might not move in the same direction as the overall market, which can be both good and bad. As we wait for the first SIFs to be approved, possibly as soon as in the coming month, it's an exciting time for investors in India. Our financial landscape is growing more sophisticated, giving you more tools to build and protect your wealth. To wrap up today's discussion on specialized investment funds, SIFs sit between regular mutual funds and PMS, needing at least 10 lakh rupees of investment. They can use advanced strategies that can make money whether markets go up or down. SEBI regulates them strictly. They are mainly for experienced investors with more money, though smaller investors might be able to access them through special funds in the future. Remember, any investment you choose should match your financial goals, how much risk you are comfortable with, and fit into your overall investment plan. SIFs are an exciting new option, but they are just one of many tools to help you build wealth. If you are intrigued by SIFs and want personalized guidance on how they might fit into your investment strategy, I am here to help. Reach out to me at Finvestin via email or WhatsApp me at 799 555 6825 or visit our website finvestin.com. And if you found value in today's episode, please hit subscribe wherever you listen to this podcast. By subscribing, you will never miss our insights on the latest financial innovations that could help you build wealth your way. Until next time, this is Naren signing off. Happy investing.